Well, what I'd like to do today is I'd like to share with you why actually there's this massively generous, untapped, unkept secret by the government at the moment. And the government are actually offering businesses the opportunity to raise finance from anyone, and those people can claim back up to 86% of what they invest from their income tax. And it's one of the most generous things that's ever happened. And I'm not going to go into the geek of it, because the geeky bits I can send you a video. I'd like to just share the exciting bits that might be relevant to you. So just a little bit of background. My name is Simon Dixon. I'm the co-founder of a platform called banktothefuture.com. You may have come across us because we are what we call an equity crowdfunding platform. It's kind of like an online Dragon's Den. What it allows businesses to do is to pitch their businesses after getting through an investment-ready incubation process and getting them repackaged and ready to pitch investors, at which point, rather than just going out and finding the rich people that can invest in you, you can find those rich people but also pool it together with money from everyday people that might be investing from as little as £10, £100, £1,000. And the massive benefits for you investing £10, £100, £1,000 in a business today is that it's actually the only way of claiming back the tax that you've already paid if you're working if you're paying yourself a salary in your business, or you got your own salary for the company that you work for. And I'd like to share with you why that's such an exciting opportunity. So the way I'm going to do this, I'll just give you a brief background on myself and how that's relevant to you, so that when we do questions later, we can dip into those. And then I'm going to tell you about 3 trends that make today one of the most exciting times. Well, tremendously. You'd be forgiven for thinking that today's a really hard way of raising, hard time to raise finance for a business, or a challenging time to start investing because of the volatility of the markets right now. But I'd like to share with you why today is the exact opposite. And the people that are struggling and reporting on the news are just simply reporting on the old world that shifted in 2007. And then finally, I'm going to share with you the new trends and what the next 10 years are actually going to look like, and how these institutions called banks might look very, very different in the future, and how technology companies are actually coming along and disrupting that entire model of finance. So I hold a fundamental belief that in the next 10 years, the entire financial system will be completely changed by digital. And I'd like to share those with you. So I originally came from investment banking. I was from the traditional investment banking world. And in 2006, I quit my job and threw in the corporate towel in order to start a business. And that business was a qualification company for students and grads who wanted to work in investment banking. I was fortunate enough at that time to have a billionaire funder that funded the business called Peter Hargreaves, from a company called Hargreaves Lansdown. So I went through that process of trying to persuade rich people, and I had that transition from corporate to complete startup, and understanding the very vast difference between going from corporate to startup. And then I started working in sustainable banking, wrote a book called Bank to the Future, and from that book we decided to co-found banktothefuture.com. And today's tremendously exciting because you're alive at a time when we've actually managed to get the FCA, the Bank of England, the Treasury, HMRC, all to change the rules in order to bring access to opportunities to the everyday person away from rich people. And I'd like to share those opportunities today. So there's 3 trends today that make today the most exciting time in history. Firstly, this one's a global trend. The first trend is global. The second are 100% unique to the UK. So you're very fortunate to be in the UK. And we're actually kicking Silicon Valley's ass with this one, and at the envy of the world at the moment for these 2 trends that I'd like to talk to you about. But the first one is that it has never ever been cheaper to start a business or to get a business growing. The reason for that is because essentially Silicon Valley in the States has been paying the bills for years for us to have global distribution television networks like YouTube. Silicon Valley has been paying the bills for us to have access to billions of people through Facebook, Twitter, and if Silicon Valley is paying the bills for our office to be replaced by Skype and free calls. And all of these little services that have come together has shrunk the cost to starting in business to nothing more than an internet connection, a laptop, and a smartphone in many cases. And almost all of us already have those devices already as our startup capital in business. Now, it used to cost a lot of money to be in business and to get started, but now that has significantly shrunk. It's why not so long ago we had 600,000 businesses in the UK, and now we have 4.8 million businesses, approaching 5 million businesses, simply because Silicon Valley is paying the bills for us to be in business. Now, that's a global trend. The startup cost has created more businesses than ever before. On the second trend, this one's 100% unique to the UK. In the UK, the government recognise that it's up to you to create businesses and employ people. And it's up to people that work to start investing in businesses in order to drive a recovery in our economy, simply because almost 60% of all employment comes from small to medium-sized businesses. And almost 48% of that comes when a business secures funding, starts expanding and employing people. So therefore, the government have done the most generous thing in the history of in fact, it's the most generous tax structure in the world. And what they have said is that anybody can invest in a business, and by investing in that business, they can immediately claim back 50% of the amount they invest from what they've already paid in tax. So if you are paying income tax, you could invest £1,000 or 10 grand or 100 grand or £10, and you could claim back a fiver, 500 quid, 5 grand, £50,000 from the income tax that you've already paid. What this means is that rather than you paying the government in tax right now, you can actually build a portfolio of assets. And one of those, if you build enough of them, might just be the next Facebook that could be very, very valuable to you. So what the government have actually done is they've created financial inclusion and allowed anybody to be an investor. So it's no longer that grey-haired old man on Dragon's Den that you need to pitch to in order to raise finance. It's actually your connections on social media, Twitter, Facebook, and the entire Dragon world has become the social world now. That's because of the third trend. And this third trend is so exciting. It's actually something that we invented in the UK, that Obama and the American economy are actually completely turning upside down their economy to copy us right now, and it's taken them about 2 years to implement the changes in law that's going to be required to this. And that invention is what we call crowdfunding. And crowdfunding was invented in the UK. And it's equity crowdfunding in particular that I'm talking about, essentially democratizes investing, whereby anybody can be an investor, starting from as little as £10. Before, it used to be punishable by a prison sentence. For a business, a 7-year prison sentence, to go out and pitch investors that weren't rich. It used to be a 7-year prison sentence if you did that. Now, we've managed to get all the rules completely changed so that you can pitch online and make anybody an investor by uploading your LinkedIn, Facebook, Twitter contacts and raising the finance and pooling together smaller sums. And those LinkedIn, Facebook and Twitter contacts can all claim back up to 86% of what they invest in you in the worst case scenario, so that it's completely de-risking. So let me put this in context of why today is the most exciting time. Firstly, there's never been more business because the cost of starting in business has shrunk to an internet connection, a laptop and a smartphone, and we all have those already. At the very same time, the government has de-risked investing for all of us, whereby you only need to risk a maximum of about 14% of whatever you invest. That essentially is going to drive a lot of our cash from tax and into business so we can all build portfolios. At the third time, the third trend, which was invented in the UK, is that now anybody can be an investor thanks to equity crowdfunding and platforms like banktothefuture.com, which we created. Essentially, it is the deinstitutionalization. It is moving the power of who gets funded to the decisions of the people rather than banks, financial institutions, rich people and venture capitalists. And now we're all investors. Couple that together and that's the key to reviving to getting a revival in our economy. So how did this actually happen? Well, it actually happened in a shift between two worlds. By the way, Bank to the Future was endorsed by Richard Branson. That's how exciting these times are. And this is what he said about our company when we created and invented Bank to the Future. But we believe that we are shifting from BC to AD. And the shift between BC and AD had nothing to do with Jesus Christ. The shift between BC and AD happened in 2007, and it was initiated by reckless banking called a financial crisis. And what happened is technology came along in the financial crisis and transitioned from the before crowdfunding world to the after debt crisis world. And what I'd like to share with you is this dusty old relic called the before crowdfunding world. And all the businesses that are struggling to raise finance and all the investors that are struggling to get a return on their investment are simply performing in the before crowdfunding world, when now we've already transitioned to the after debt crisis world. So here's the dusty old world, and this is what it used to look like from both the perspective of investors and businesses. So if you need to raise finance, firstly, the difference between a sandwich shop and a pret-a-manger is simply that they went up this graph and they went up this curve. The pret-a-manger learned how to package their business in a way where it could access the vast cash driven by our financial system. The sandwich shop stuck with their own money. The difference between the sandwich shop and the pret-a-manger is the following. Now here's the difference. The old world, the sandwich shop, used to need 50 grand minimum to get started. It needed offices, it needed rent, it needed staff, it needed infrastructure. What's happened today, as I said, is this 50 grand startup cost. This is what we call in business terms the friends, founders and families. It was always funded by founders of businesses that either saved up their own money or pitched their friends and family, simply because no one else believed in their idea, because it's really hard to get someone to believe in an early stage concept. In fact, the hardest money you will ever raise in a business is in fact the early stage of your first 10 to 100 grand. If you want to raise hundreds of millions here, it's a lot easier than persuading someone to invest 10 to 100 grand in you, which is why it was always the friends and family. Okay? Now the challenge with that, as you as an investor, is that you needed to risk your money on your son or your daughter or whatever it might be, and put it all into a business rather than diversifying and using sensible risk management rules with your money. And therefore the son or the daughter who created the business feels really guilty when it doesn't work, simply because you put the house on the line or whatever it might be. So what used to happen is, once you took that friends and family and founders money and you actually drove some sales and you created product, you used to be able to go to a bank in order to get an overdraft or get some additional capital in order to grow that business. Now the way that the banking system works is, you as investors, you deposit your money in a bank and you receive 0.0 whatever % on it, because they're re-lending it at a much higher percentage, okay? So traditionally the banks used to make the money on your savings by lending it out here through overdrafts. But that's completely changed in the after debt crisis world. So at that point it was the bank making the profit, okay? So what used to happen is, you used to get that. Now, if you're a business seeking funding and you're trying to raise finance from a bank, let me tell you the secrets of what it is to raise finance from a bank. Firstly, they're not interested in business plans. They don't know how to analyze business plans. They're not entrepreneurs. They're people that work for companies, yeah? And what they have is, they have two requirements in order to lend to you. First requirement is that you can show a proven track record of your ability to repay debt and interest. And so you must have taken out debt and interest in the past in order to get some more debt and interest. And you must have generated cash flows for the last couple of years minimum in order to prove to them that you can repay debt and interest. But that's not enough. They also want security. And security means that you need to put your house on the line or your assets on the line just in case it goes wrong. So your job in securing funding from a bank is not showing, this is my amazing idea, this is my amazing product, here's this amazing business plan. It's, here's how I'm going to repay cash plus interest, and here's what I'm going to give you if it all goes wrong. And that's all you need to do to get funding from a bank, okay? Now unfortunately there's much products that they'd much rather lend to, like mortgages and all sorts of stuff. So it's very tricky to get it in there. But that was the before crowdfunding world. Very tricky to get it from the bank. Now, if you took your product and you took that idea and you generated sales, and for a couple of years you proved to the bank that you could repay interest, then you used to be able to go back to a really wealthy, rich person and get them to invest in your business. They're called angel investors. Now, in the before crowdfunding world, it was very hard to find these angel investors. The reason being is because of the sheer wealth that they needed to have in order to be able to invest in you in a sensible way. So in the before crowdfunding world, the average angel investment, in order to make it worth it, because there's big legal costs and all sorts of stuff in securing angel funding, is that they need to invest about 100 grand in a business. And they'd also need to invest in about 10 businesses because, you know, they need to diversify in order to make a couple of them work and the others not work. So 100 grand in 10 businesses means £1 million. Now, if they're any sensible angel investor, this would only be 10% because this is the high risk, high return part of their portfolio. And therefore, if 10% of it means that it needs to have an investable portfolio of £10 million. So you're looking for somebody that has spare cash in the tune of £10 million in order to make an investment. And how many businesses are there that need funding compared to the people that are willing to invest in business that have £10 million spare? So it became a game just for those ultra-connected people that went to Oxford and Cambridge or worked in the finance sector and happened to know these people. For everybody else, it was a bit tricky finding these people, and it required genius entrepreneurial talent in order to get an angel investment. It's why a tiny portion of businesses seek angel funding. But if you get to the point where you have that rich, wealthy person invest in your business, and the problem with angel from the perspective of an investor is you needed vast wealth to get started to do this properly, and that's why all of the biggest deals were reserved just for the rich people, okay? But if you got to this stage, you managed to successfully get your business where a rich person would invest, you got to what we call the institutional side of the funding cycle. And in the institutional side, you used to get venture capital money, and this is the difference between the sandwich shop and the pret-a-manger. The pret-a-manger would have injections of vast wealth from you contributing your pension money to a financial institution, and that financial institution investing it in companies that are on the verge of vast growth. And that's what the venture capital market is, okay? The difference between an angel investor and a venture capitalist is they're spending other people's money, your pension, and these people are spending their own money. That's the difference, okay? So, once you had the venture capital money, this is where the pret-a-manger exists. Once you've got that, you are you're able to access hundreds of millions, 25 millions, through public offerings, private equity, and all sorts of other geeky stuff that I'm not going to go into today. But that's where, and then you were able to borrow the money, and that's where this vast sum of wealth comes. That is the difference between the big brands that you see here today and the small to medium-sized enterprises. They learned how to repackage their business in a way where they could access the vast sums of institutional money. So the challenge was, in the before crowdfunding world, is that this was only reserved for the ultra-successful businesses, and this had never ever had a well-defined process for a business to secure 10 grand to 100 grand to £1 million in a well-defined process ever. So what happened in 2007 is technology stepped in the way and said, screw this, let's disrupt that model. And so we transitioned in 2007 out of desperation because businesses were not securing funding into the after-debt crisis world. And in the after-debt crisis world, here's exactly what it looked like. As I said earlier, the cost to starting in business, the friends, founders and family round, shrunk to an internet connection, a laptop and a smartphone, thanks to YouTube, Salesforce, Skype, Facebook, Twitter, and all the other tools that you're probably learning about on this digital marketing exhibition. So the cost shrunk. And then came along an invention that was that changed the game. And it was invented in the creative sector by independent movie makers. Independent movie makers did not have the privilege of accessing vast wealth unless they already had the cast all lined up and they managed to get Arnold Schwarzenegger to appear in their movie. But what they could do is they could create brilliant traders and creativity. So essentially what they did in this sector is they said, well, what if we could create a video with our movie and we put it online and people could act, and then people could give us money to make the movie happen. And if they gave us 10 quid, then we'll put them in the credits of the movie. If they give us 100 quid, we'll put them in the credits of the movie, invite them to the movie premiere. And if they give us £1,000, we'll invite them to the movie premiere, put them in the credits of the movie, and make them a non-executive producer. And so crowdfunding emerged, and online, so you might have heard of companies like Kickstarter, that actually Kickstarter copied a company called Indiegogo. But Indiegogo and Kickstarter invented this crowdfunding market. And so when businesses realized that you could raise finance through contributions, they actually started to get involved. And a very famous example of a crowdfunding, which was a company called Pebbles Watch. You might have heard of it. Pebbles Watch invented a phone that speaks to your iPhone, and you can control your iPhone through your watch. And they went to venture capitalists, and the venture capitalists said no. So they went onto the crowdfunding site and created a video, said, here's the team. We're going to create this watch, and in 9 months' time, we're going to deliver this watch and sell it for $200. If you would like to contribute $150 today, then we'll give you the watch in 9 months' time once we created it. In a month later, they had 37,500 pre-orders and $10.3 million in the bank from this. It completely disrupted the model where you pitch your idea and then people contribute on the market research of whether they want your idea to happen, rather than you finding all the cash and then not knowing whether the market wants it. So it's like the most amazing form of pre-research and raising finance and marketing all combined to one. That was crowdfunding. Now, I give you the story of the 10.3 million, but that's not the average crowdfund. The average crowdfund is about £10,000. It's a little bit less sexy than that story. So what happens when you need to raise more than 10 grand, and for a business that might not be as particularly creating a product that everyone can understand as easy as a watch? Well, that's where Bank to the Future came in. And Bank to the Future just said, well, screw this. What if we could get the Treasury, the Bank of England, the Financial Services Authority, the Financial Conduct Authority, and Her Majesty's Revenue and Customs to completely change the rules? So we spent 3 years persuading all those institutions to change the rules, and now they've changed them. And what they said is that now it's possible for you to put your business online through an equity crowdfunding platform like banktothefuture.com and offer shares to anybody that wants to invest. And you can do that through Facebook, through Twitter, through LinkedIn, and all your vast social media connections. And they're allowed to invest compliantly without you going to prison for 7 years, as it used to be if you pitched someone that wasn't rich. And not only that, but what if we could give them the opportunity to claim back 86% of their tax from the money they've already paid in their income tax? And that's exactly where we are today, the 3 trends I talked about earlier. So now you're the bank, you're the venture capitalist, and you're the rich angel investor, and we can all participate in the game that only used to be available for the rich. And if you are paying income tax, then you can claim it all back, a massive chunk of it back, by investing in private companies. That's what Bank to the Future created. That's what we call the equity crowdfunding market. So what we do is we take businesses and we help them repackage themselves in a way where they can pitch investors online through their business plan, valuation, claim the tax, get all the legals done without paying any of the massive upfront costs that used to cost in being involved, because we digitized the whole process. And then what came along, and in November we'll be launching what we think is disruptive to the banking model. And what we said is, well, rather than the banks making the profit, there's loads of people that are depositing their money with a bank and receiving 0.0 whatever interest. What if they could receive the interest that the banks receive through issuing the loans? And so we created the crowd lending market. I'm almost finished. And the crowd lending market essentially says, rather than you deposit your money at a bank, why not lend it to lots of businesses, diversify across lots of business? We make sure they're creditworthy, and because we're not a bank, we've got low overhead, and we can just match you up all online through our system and manage all the repayments. You assume the risk of default, we make sure that they're less risky. And essentially that means that you can get a much higher return on your savings, and creditworthy businesses can now borrow from the crowd rather than the banks. This is what the after debt crisis world looks like. And then now, for the very first time in history, there is a well-defined, well-structured process for you funding your idea through crowdfunding, funding your business through equity crowdfunding, and allow anyone to be an investor and claim back tax by investing in you. And now the banks are you. The people are receiving the interest rather than the banks receiving the interest. Once you have passed through that flow, you can access the vast sums that make the difference between the sandwich shop that doesn't know how to access finance and the pret-a-manger that has access to all the institutional money. Today we are at a shift from the deinstitutionalization, the disintermediation of finance, and you are all a part of it, and we invented it in the UK. And thanks to social media, thanks to those three trends that we're talking about, it's the most exciting time to be around, and you're all early adopters, and I think that we can shift from a world where banks and financial institutions decide who gets the money to you deciding who gets the money. You're the bank, you're the VC, you're the angel investor, and it's up for us to actually take this. So if anyone is excited by that world, if anyone would like to raise finance, if anyone would like to claim back their tax and build a portfolio instead of giving it to the government, then you can go see me or the team over there at Bank to the Future, and we'll zap you and send you some videos on exactly how you can take advantage of this vast array of opportunity that's happening out of a financial crisis. I hope you enjoyed that. I'm over by 1 minute. I'll be over there to answer questions. Thank you very much.